Good afternoon, ladies and gentlemen. It is my honor to welcome you to this very special seminar brought to you by Thailand's Security Institute, or TSI, and Thailand Futures Exchange, or TFEX. Today we have the privilege of hearing from Mr. Rajib, Ranjan, Borah, and Mr. Nitesh, Khandelwal, to speak about options trading technique, a trader's approach for retail investors. Before we start, I would like to introduce Dr. Grisada Sektrakoon, Director of TSI, the Stock Exchange of Thailand, to present a welcoming speech for all of us. Dr. Grisada.
Mr. Rajib, Ranjan, Borah, Mr. Nitesh, Khandelwal, Dr. Rinjai Chakornpipat, the SVP of the Stock Exchange of Thailand, honored guests, ladies and gentlemen, it is my pleasure to welcome you to the seminar on options trading technique, a trader's approach for a retail investor. This seminar is jointly organized by the Thailand Futures Exchange, or TFEX, and the Thailand Securities Institute, or TSI, who have jointly cooperated in hosting this seminar for 2 years. And this year, we have as additional sponsor from Factory Trade and Quant Institute. Options are a powerful tool and are particularly beneficial in creating returns on investment because they can create opportunities to earn unlimited returns while limiting losses for investors. Additionally, options can be used in a variety of investment strategies. Options, therefore, are a tool popular among investors, especially in the capital market of developed countries. For Thailand, investors who are interested in trading this kind of instrument can do so on the Thailand Futures Exchange, or TFEX. TFEX established the first option trading starting in 2007 with the Z50 index option. However, over the last several years, options trading on TFEX was not as widely known as popular as it should have been. This was the result of several factors. Most importantly, the number of investors who have knowledge and understanding about the tools and strategies in option trading is still quite limited. In addition, the liquidity of the Z50 option trading was still relatively low, making it difficult to trade options. However, TFEX is striving to correct and improve restrictions on the liquidity in the trading of Z50 options by encouraging the market makers to provide more liquidity for the Z50 index options in the model of continuous quote for greater offers of bid and ask prices from past September the 1st this year. As a result, there are signs of improved liquidity and the volume of Z50 options contract trading has increased. This is a positive trend for investors who want to take advantage of option trading. So today is a good opportunity for everyone attending to learn and understand more about options trading. You will learn strategies and techniques for options trading from experts who have direct experience in this field. They will share their knowledge and experience, whether it is in basic options or sophisticated options trading. You will also gain a perspective on the outlook for options trading worldwide and its direction. So this seminar is a very good opportunity for Thai investors and professionals who are interested in learning and exploring trading techniques of foreign institution investors in order to apply these techniques to trading within Thailand. I would like to thank both of our guest speakers for sharing their knowledge with us. The organizers are confident that those attending today will benefit from the knowledge and valuable experience of both speakers and will be able to bring the knowledge and techniques learned to apply in options investing and managing portfolios in order to successfully generate financial gains in the near future. Ladies and gentlemen, thank you for your attention. I now officially declare the seminar open. Thank you. ขอบคุณครับ
Now I think we're going to have Dr. Grisada present a souvenir to Mr. Rajib. Actually the co-founder and the director at iRage Capital Advisory and at Quant Insti, Quantitative Learning. As for his background, Mr. Rajib worked with a leading HFT firm called Optiver in Amsterdam, working on options derivative, market making, and high-frequency equity arbitrage strategies across all major exchange and U.S. exchanges. At present, Mr. Rajib actually designs HFT system for Southeast Asian markets, actually helping to generate a significant amount of volume within the options segment. At QI, or Key, Mr. Rajib actually manages the cost segment on options derivative and also work with exchanges, financial and educational institutions to design educational programs. As for Mr. Nitesh, he actually has a rich experience in financial market spanning across various asset classes in different roles. He also co-founded iRage Capital Advisory, where he led the business side for iRage Capital and QI. At Quant Insti, he was also the head of department for training in derivative and intermarket studies. And at present, he is currently the director at iRage Global Advisory Services, which is based in Singapore. Ladies and gentlemen, please welcome Mr. Rajib and Mr. Nitesh.
Hello, everyone. Thank you very much for the kind introduction and the kind words that you had. So I think without taking much of time, we can directly jump to the topic of for today's seminar, that is option trading techniques and a trader's approach for a retail investor. Okay. I hope this is better. Yeah. Okay. Cool. Okay. So now before we start, we would first of all, if it would be great if we can keep it slightly informal. A lot of questions. If you have anything in between, just keep them pouring in. We will be happy to put a path around your questions as we progress in the for the seminar. As part to that, can I ask few questions to you guys and see how well we should progress on this, how and what would be the best manner to progress on this seminar? So first thing, how many of you trade options? How many have traded options so far? Okay, okay. Some hands coming up, which is good. And how many have read about options? Okay, more hands. Okay, always good. So in that case, let's since I understand that a lot of people who do not have much exposure to the options, we'll try to start right from the. We'll put more emphasis on the basics and see how those basics can be used for creating various kind of trading strategies. So which we'll take up in the second half or maybe later in the seminar. All right. So. First thing, options. So this is the flow that we have in mind, but we are totally open to changing this flow. We'll be happy to change it as per your needs or your questions. That should be fine. So it's not sacrosanct, but this is the tentative one. So first we would like to talk about a bit on the option fundamentals. basically understanding basics of options and derivatives, what are various kind of options, what should be the value of an option, all those kind of things. The more focus obviously would be on options. Derivatives is a much wider domain, but we'll be putting more emphasis on the options for today. Next, we'll be running through simple option trading strategies based on various directional movements or volatility or interest rate or several other kinds. So based on which we can create different trading strategies. And if you have some view on anything, you should be able to execute that view using options. So that's one of the objectives of the seminar, that you should be able to think about some strategies at the end of the seminar. You should be able to think about some strategies which you can create using the very simple basics of options. All right, so these two are the most focused things which we plan to do. Other than that, we also plan to look upon a bit on the managing positions, on how we can handle risk in the options, because it's quite different from how you do it in the securities or stock markets. So we'll be doing a bit on the risk management part, the Greeks for options, if time permits, and then some advanced trading strategies, some complex position automation based strategies based on options. All right, so the basic question, what is a derivative? Because before we move to option, we need to know what exactly are derivatives. So derivatives are nothing but some financial instrument which is deriving its value from something else. Something else need not be necessarily need not be necessarily a financial instrument in itself. It can be anything. So like there are derivatives which are based on like weather derivatives, so which are based on what temperature it would be 3 months down the line. Okay, and as well as there are index options as well. Like we just heard that like S&P 50 have options which has been trading since 2007. So it can be on anything. It can be index, it can be stock, it can be commodity, it can be interest rate, it can be weather or any other thing as well. So in among those derivatives, the specific one is called your options. Options is nothing but, as the name suggests, it's an option, which means it's a choice. All right. So obviously nothing comes for free, and similarly options also does not come for free. So there would be some premium which you'll have to pay to get that option. All right. So as the text definition says, that option is a special type of derivative instrument. The buyer of the option has the option but not the obligation to buy or sell an instrument or underlying asset at a specified price on or at times or before a specified date. Okay. So other type of common derivatives, I think that we just mentioned for your sake, it's futures, in which you have the it's more of just like a stock, but the only difference being that you are obligated to buy or sell at a specified date. All right. So that's there. And forward is nothing but very similar to future, but they are over the counter, which is they are not traded on the exchange, but between two individual parties. Okay. All right. So now the options. So there are, during all our discussions today, we'll be keeping options as the vanilla options. So basically the simple options that we have. So in that you have primarily two types of options. One is your call option, another is your put option. Now, call option. So call option is the buyer. So for any option, there would be two parties, always. One would be a buyer, one would be a seller. It cannot be like in the market, everyone is a buyer. It cannot be like in the market, everyone is a seller. Either of the cases is not possible. It has to be equal. There would be one option buyer, there would be one option seller. Now, as you saw on the previous slide, the buyer gets the right, but not the obligation, to buy or sell a underlying. So in this case, the call option, the buyer gets the right to buy the underlying asset at a pre-specified price. Okay. Similarly, for put option, the buyer has the obligation, but not an obligation to sell the underlying. Okay. Now, let's take a simple example. Say, for example, if you're trading, say, gold, all right? So, say, gold in dollar terms, so that would be around, say, $1,500, for example. So, if it is trading at $1,500, you want to buy an option where you want to buy the gold at, say, $1,400 at a pre-specified date. Okay, so I say that 2 months down the line, 2 months from today, I would like to buy gold at $1,400. So now, for that, to do that, I would have to pay something to the option seller. So who is willing to take the obligation that he is willing to sell the gold to me at $1,400 at a pre-specified 2 months down the line. So this 1400, which I just said, is what we have the strike. That is what we call the strike. Okay, the price of the underlying at which option can be exercised. So when I actually go and make that decision of buying it at 1400, so I would say that I am exercising my option. Okay, expiry date, as I said that. If I am saying that I will be buying the option or buying the gold from you at 1400 after 2 months, so that 2 months, the 2 months from today, that's the expiry date. Okay, the date at which the option can be exercised, and the premium. Now, premium, this is the tricky part, that how much I would be paying for getting that option. So I think one thing would be quite natural, that if it is the current price is at 1500, then in most likely circumstances, I will be supposed to pay more than $100 for that option, right? Because if I buy it and if I sell it immediately, if I have an option to sell it immediately after buying, then $100 is what I'll be pocketing in right away, right? So it has to be more than 100. So we'll be covering more on it in the next slide. So basically, but the premium is the upfront payment that you are making to the option seller for buying that option. All right. And then you have option styles. So there are two major ones. One is your European. So European can, so basically, when I said that for the gold, I want to buy an option, a call option in which I'll be getting to buy the gold at 1400. That's so 1400 is the strike, and within next 2 months. Okay. So if I say that I can only exercise it at the end of 2 months, that means that I'm talking about a European option. All right. If I say that I want to exercise it anytime till in the next 2 months, in that case, the option is American. Okay. So European and American, it's nothing but the different style of options based on when you can exercise the option. If you can exercise it only at the expiry date, it's European. If you can exercise it any time till expiry date, it's American. All right. Apart from that, then you have exotic options like Bermudan, Asian. Like Asian, you have the average of the prices of all the month. There are different kind of exotic options as well. But our main focus would be on European and American for now. Okay. So we have this, what we just discussed, written in a more structured format. So where you have the call option, the buyer has the right, but not the obligation to sell, to buy, right? So when I bought that call option at the strike of 1400 for gold, I am getting the right to buy at 1400, but I am not obliged to buy at 1400. So if, say, the market price after 2 months goes down to, say, 1000, for example, so it doesn't mean that I still have to go and buy at 1200. I can go in the market and buy at 1000 and ignore this option, because it was an option for me, it was a choice. So it was my right, but not the obligation. But for the seller, it's pure obligation, because if the market goes up, then he has to sell, because I will be going and exercising my option to buy at 1400. So if at the expiry, the price is above 1400, in that case, I will be going and exercising my right, which means that the seller will have an obligation to sell to me at 1400. So if the market price goes up to, say, 2000, so even though the market price is 2000, but I have an option to buy at 1400, I go and exercise that option, he faces an immediate loss of $600, right, for every contract, minus the premium that was received. So that's for the call. So buying looks more natural somehow than selling. I don't know why, but that has been the case. So for the put option, it's exactly what call option is, but just that instead of buying, it is selling. Okay? So you have the right, but not the obligation to sell. So just think about like the same example, gold price right now at $1,500. I want to sell it $1,600. I want an option where I can sell it $1,600. So I go and buy a put option. If I buy a put option, that means that in next 2 months, if the price goes below 1600, if it is below 1600 or goes further down the 1500, 1400, all the way down, then I'll be making profit because I'll be exercising my right to sell. But the guy who has sold the put option, he has a potential obligation to buy. So instead of in the call option, the seller had the potential obligation to sell, and in the put option, the potential obligation to buy. So if the price goes up in case of a put, the seller does not need to worry. But if the price goes down for a put, in that case, seller has a good reason to worry. Okay? So is it clear so far? Anything anyone wants to raise any point or anything? All right. Okay. So this is basically a payoff from holding a call option instrument. Now, before we go to this, let's see why are there option sellers and not option buyers? Because what we have seen so far, option buyer has the right, and option buyers enjoy the upside. They have limited risk. Then why should there be any option sellers? Because of the simple thing that when we were buying a call at 1400 strike, when the market price is at 1500, and for 2 months, approximately assuming the volatility of gold at present levels, it would be somewhere in the range of $150 to $200 minimum, right? So the person who is selling the option, he is making that $200 premium for giving a right to someone who that can be exercised. So now if he has a view that he is not expecting gold prices to go up a lot, that's all right. So he'll pocket that 200. But even if he feels that it might go up, but not a lot, it would not go like $200 above from here. So in that case, still he is not at a loss. So that's why you will see a lot of call options, a lot of option sellers who are there in the market. And in fact, interesting thing is that most of the professional trading groups, they are more in the option selling than into option buying. Yeah.
Interject. Just think of options as insurance instruments. So basically someone who is scared that what will happen if the price goes up tomorrow, what he will do is he'll buy a call option slightly higher. So he'll say that tomorrow, irrespective of whatever is the price, I can still buy at 30. So irrespective of whether the price goes to 42, I can still buy at 30. So that's the insurance that he has bought. And because he has bought the insurance from someone, the person who has sold the insurance will, similar to an insurance premium, he will want a premium. Likewise, similar to calls, you have puts wherein you say that, okay, I'm scared, what if the price of the asset falls down? So you say that irrespective of whatever be the future price, I want to sell at a particular level. So that's an insurance. And for the insurance, the person who is selling the insurance wants a premium. So that's the premium that the seller gets. Yeah, sorry.
Yeah, sure. So yeah, that's quite an analogy that like most of you must have had insurance policies, right? So for insurance, it's just like you're getting an insurance, paying a premium for a much bigger upfront payout later on, maybe, right? Okay, so regarding the payoff for holding a call option instrument. So if it is clear that what is a call option and how it works, in that case, it's quite simple. That it's considered a call option. So for this particular stock, what we are doing is that we are keeping a strike price of 30. Just as for the gold, we are keeping at 1400, right? So for this stock, we are keeping a strike price of 30, expiry date 30th August 2015, say for example, okay? So now, at the expiry, so like 10 months down the line, the expiry, the payoff of the call option to the buyer. So this is from the buyer's perspective, okay? Not from the seller's perspective. So for the buyer, you have till 30, you're not making anything, right? So because if the price is below 30 and you bought a call option, which means you have a right to buy at 30. So, but if the price is below 30, then you will not be buying it from by exercising the option, right? But you will be probably go in the market and buy it at 28, 26, whatever price it is at. So till that time, it is worthless. But once it crosses 30, that is when it starts making money for you. So if it is above 30, then you will be exercising that call option that you have bought. Okay, so it simply goes up linearly. So if it is 32, you make $2. If it is 34, you make $4. If it is 40, you make 10 bucks, right? But please note that this is just the payoff. This is ignoring the premium. We are ignoring the premium. When we say option payoffs, we just talk about what will happen at the expiry, what would be the payoffs as in for every option that we are exercising or not exercising, what would be the respective payoffs for them. We ignore the premiums while calculating the payoffs. So in this case, since the strike price was 30, that's why you see that line going up from 30. If the strike price was, say, 36, it would have gone flat till 36 and then shot up just like this with the same slope. Okay? All right, so in this case, the example that was given was same that the buyer, if the underlying price is at 36 on expiry, then the buyer of the option can buy the underlying at 30. So your payoff becomes 6, which is exactly where it is. Okay. So similarly, for a put option buyer, can someone take a guess what would be the payoff for a call option seller? Looking at this, would it be the same? Would it be opposite of would go like this, horizontally inverted or like vertically inverted? Anyone willing to take a guess? Yes, no. Okay, all right, so I think we'll be covering that in the later slides, but it would be inverted horizontally because the money that option buyer is making, since there are only two parties, option buyer, option seller. So if this guy is making money, option seller has to lose money, equal amount of money, right? So it would be just inverted horizontally. So over here, you can place a mirror on the x-axis and you will see it's inverted, okay? All right, okay. Now, the same thing for the put option. In put option, the same stock, same strike, XYZ stock, strike of 30, expiry date, same 30th August 2015, for example. Okay. So in this case, in a put option, when I'm buying a put option, what am I getting? I'm getting right to sell, right? I have a right to sell, but nothing for buying perspective. So I'm not getting any rights or obligations to buy. I'm just getting a right to sell. So till the time it is about 30. So 30 is my strike price. So that is the price at which I would be able to sell, exercise my right to sell at 30. So if it is at 34, so would I exercise my my option to sell using this put? No, right? Because I can go in the market actually and sell at 34. If the underlying price is at 34 on expiry, then I would rather sell it in the market rather than selling it using the put option. Because in the put option that I bought, I get to sell, I have gotten the right to sell at 30 only, not at 34 or anywhere above that. So if it is above 30, I will go and sell in the market rather than selling it here. If it is below 30, then I will be exercising this option. So when it is below 30, this is the area where we are getting any payoffs. Above that, there is nothing. The option is worthless, right? So in a put option, you make money if the underlying price goes down. In the call option earlier, you were making money when the underlying price goes up. Okay? All right. Now, so these are different option payoffs. So now we have again, all right. So so we have taken premium into account for your understanding here. So in this case, we have assumed a premium of $2 for that $30 $30 stock. The strike price was 30. Now, on x-axis, you have underlying price. So that is the XYZ stock. On y-axis, you have the profit from holding that call option by buying the call option. Okay? So, if the premium is $2, the strike price is $30. So when I go and buy a call option, what do? I give $2 from my pocket right away, okay, to the option seller, and tell him that, boss, my option, I will have a right to buy at 30. So if it goes about 30, if it goes above 30, I'll come back to you and buy at 30 from you. So, and I'm willing to pay you a premium of $2 for that. So option seller is fine with that. So I go buy. So my net payoff has already been $2. Okay. So that's why you start at -2, because you have already paid this money to the option seller. So till the time it is 30, you're not going to exercise your option, right? So you'll be making a loss of $2. That's it. And you go and buy from the market or whatever you want to do. But from the option, you're not getting anything. You have lost $2. But say if it goes up to 31, so do I exercise my right to buy at 30? Yes, I do, because it is about 30. So I am getting to buy at 30. So I'll exercise that right to make that $1. But would my net profit be $1 or $1? No, that won't be the case, because you have already paid $2. Okay, so it's just that your net loss has reduced to -1 from -2. But it's not like that. It will become profitable. So it only becomes profitable after it crosses 32. So that is 30 plus 2, the $2 of premium that you have paid. So once that is done, after 32, you start making money on that option position. Okay. Similarly, for now this is for your option seller of call. So if you've sold a call option till 30, it's nothing. It's you're good. You're good. You're making $2, which you have received as premium. Nothing else. So you don't need to pay anything. The other guy is not going to exercise the right because the price is below 30. So he's not coming to buy from you at 30. So that phase, it's okay. It's all right. So, but once it start going above 30, so in this range of 30 to 32, that is when the option buyer would be coming to sell, to exercise his option. That is to buy from the option seller at 30, buy the underlying at $30. Okay, but he'll still make money because he already have received this $2. Okay, as the premium. So till 32, he's okay. So he's not making a loss, though his profit is gradually decreasing. After 32, he will be making a loss, because $2 is all he had received. And now if he's going to sell at 30, he's going to sell at 30 while the market price is at 33, then yeah, he will be making a loss of $1. Okay, so this is for call option buyer. This is for call option seller. As you can see, it's nothing but inverted on this horizontal line. Okay, for buyer and seller. Similarly, over here, for payoff for buy put options. So in case of a buy put option, what you're getting, again, I'll repeat so that it gets into your system, so gets imbibed totally. So it's basically your put option buyer, he is getting an option to sell. So that means a right to sell. So that means the same thing, $2 as the option premium for a put option, $30 as a strike price. Okay, so that means that till 30, below, if it is below 30, you will be exercising that option because you're getting to sell at 30, and above 30, it will be worthless, right? So above 30, you'll be losing $2. So in this case, your net PL goes negative, not at 30 or 32, but at 28. Okay? If the price is about 28, that is 30 minus 2, $2 for the premium that you have paid for this put, for buying this put. So from 28 till 30, you start losing money. Below 28, you make money. Okay? Similarly, for option put option seller, it's an inverted graph for payoff. He makes about 30, he makes $2. Between 28 and 30, he makes whatever is the price minus 30 minus that price, and you subtract that price from the $2 that you have received. So if it is at 29, so he will be making $1, and if it is at 28, he will be making 0. Below 28, he starts to lose money. Okay, but about 30, he makes pure $2 of the option premium that he had sold. Okay, so looking at this, you can see that buying options for both these things, buying options is okay. So buying options, you see that the downside is not unlimited. The downside is only you have the $2 of option premium that you have paid. That's the maximum that you can lose, nothing beyond that, okay? But in case of when you're selling the call option, so you have the maximum that you can lose is actually infinity, right? So it's a risky business, option selling. So, so that's why if you want to use options for hedging or related things in which you want to play safe, typically you go for option buying. But the thing is that the premium that you're paying, it's likely it's possible that you will lose all the premium, right? If it is in this range, okay? So, okay. Now, okay, so this was all about the payoffs, and over here you have the moneyness. So moneyness, let us define moneyness first. So what is moneyness? So moneyness is your the terminology is in the money, at the money, out of the money. So moneyness is how much in the money is that option. So when I say in the money, what we mean is that if you have, say, in this option, when we had bought a call option, right? So if it is the strike is at 30 and the price is at 40, so that means that this option is 10 rupees in the money. Why would we say that? Because if you are allowed to exercise that option right away, in that case, you are getting to buy at 30 and selling at 40, you're making money. So if you're making money, you're in the money, all right? So that's for the call option if the underlying price is greater than the strike. So if the underlying price that is on this axis, x-axis, so if it is 40, 42, 38, whatever, and the strike price is 30, then you have the underlying price is greater than strike. So we say that it's in the money because I'll be making money if I execute it right away. Okay? Same thing for put option, it would be other way around. So it would be in the money when it is below the strike price, because then I would be able to sell at a higher price as what is there in the market. Okay, so I can buy from the market, it's at 24, if the price is at 24, and sell at 30. Okay, so it's like 6 rupees in the money, $6 in the money. So that's for the put option. So in call option, underlying price greater than strike. In put option, underlying price less than strike. Now, the same thing for the at the money is when the price, the strike price, is same as the underlying price. So when the underlying price of the asset class for which we are buying or selling the options, if it is same as the strike, say if the stock price is at $30, in that case, we say that underlying price is equal to strike price, it is at the money. So like, you're neither floating in the money, you're not above the money, but you're just at the money. Okay? So that would be same for both call and put option. And for the out of the money, so that's like you're out of the money, so there's no money in your pocket, that kind of thing. So you have underlying price in call option if the underlying price goes below the strike price, which means this area again. So underlying price is less than the strike price, which means you are not going to exercise that option because you can rather go and buy in the market the underlying rather than using this option for buying that underlying. So for that, we say that that would be out of the money option. Okay? And put option, similarly, underlying price would be greater than strike. So this area of yours. So about 30, that's the out of the money range. Okay, so to think of it, why would you buy out of the money options? You buy out of the money options because they're cheaper, right? So if when we were taking that example of gold, so when it was trading at 1500 and the underlying price and the premium, the strike price that we were looking for was 1400. So in that case, it was in the money by $100, right? If I want to actually do the same for 1600 instead for a call option, so that means my strike price is at 1600, which is $100 higher than the current trading price. So in that case, what we'll say is that that is the out of the money option. So the premium that we'll be paying for this out of the money option would be much lesser than the premium that we would have paid for a $1,400 strike price option, call option. Okay? All right. So now this, the example that we just took, 1400, 1500, 1600. So now 1500 is your price that is there currently in the market, and for the underlying, 1400 is one strike, 1600 is one strike. Okay? So now 1400 is the one which is in the money. So when I say in the money, it's like $100 in the money. So it has an intrinsic value of $100. So that's what we call it, that immediate value of the option given the current relationship between the price of underlying and the price of the option. So that is your intrinsic value. So if I take that option and exercise it right away, what am I getting? So in case of the strike price of 1400, what I'm getting is $100. In case of a strike price of 1600, what I'm getting is 0, right? There's nothing because the current price is at 1500. If I go and buy at 1600, there's nothing that I'll be making, right? So that's your intrinsic value. So for call options, intrinsic value is underlying minus option strike. So underlying price right now, 1500. Option strike, 1400, so it has 100. If it is 1600, then it cannot be negative, but it would be 0. Okay. Similarly, for put options, it would be exactly the other way around. So you have option strike minus underlying price. So if the underlying price is below the current option price, below the strike price, then it will be in the money. If it is above, then it will be out of the money. So if it is in the money, it will have intrinsic value, which is equivalent to option strike minus underlying. If it is out of the money or at the money, the intrinsic value will be 0. Now, this is the more like the intrinsic value which you can directly see what the strike price is and what the underlying price is. You just do a simple calculation and you're good, right? You can calculate that. But the more trickier part is the time value. So now, if I have this option where I am buying at buying an option with a strike of again 1400 and market price 1500, and it is valid for 2 months. Okay, so this option, which has 2 months to expire, also has some time value, because the price might go up, go down, anything can happen, right? So the premium that you have already paid, it has to say for that time value that you're getting for that option of 2 months, that also has to be indicated in the pricing. So that would be your time value for the option. And in case of out of the money options, it's only the time value. There is no intrinsic value, only the time value that you pay for. And always note one thing, that option prices can never be negative, because you are getting a choice, you're getting an option. So for getting any right, you would not be getting it for free. You'll always be paying something. So for that, there's a premium. So I think I'll pass it over to Rajib to take it further from here on the pricing side.
Hi, good afternoon everyone. So say you have to price this bottle of water. How would you price this bottle of water? What would you do? How much would you pay for it? So you would look at the characteristic of the bottle of water, right? You will say that what is the clarity of the water, what are the minerals in it, what is the quantity of water, and so on. So likewise, to price an option, what you would do is you would look at the characteristic of options. Now, Nitesh has given a very nice description about options, what a call option is, what a put option is. So now you guys know some of the characteristics of options. So what do you think are the characteristics that are relevant towards pricing an option? For example, to price this bottle of water, you look at the quantity of water, you look at the clarity of water, purity of water. Likewise, to price an option, what do you think would be the characteristics involved? So, pardon? Duration. Okay, so basically if you have an option which expires 2 months from now versus another option which expires 3 months from now, say an option expiring tomorrow versus another option expiring 2 months from now. Okay, so if you buy an option expiring 3 months from now, you're basically getting an insurance for 3 months. If you're buying an option expiring 2 days from now, you only have an insurance for 2 days. So for an option expiring 3 months from now, the premium will be higher. So that's a very correct answer with respect to a characteristic used for pricing option. What are the other characteristics used for pricing options? One is the time left in the option. So basically if there is hardly any time left in the option, you are not going to pay much for it. But if there is a lot of time left till expiry date, you are going to pay a lot of premium for it. Okay, what other characteristics can you think of? Well, remember Nitesh mentioned about in the money, out of the money. So if an option, so if you are buying a call option with a strike of 1,000 and the underlying is priced at 2,000 versus you are buying a call option with a strike of 3,000 when the underlying is at 2,000, in which case are you going to pay more? In case you are buying the call option with a strike of 1,000, you will pay more than with a strike of 3,000. So the difference between the strike and the underlying price, that is going to be another characteristic. Okay. Now imagine there are two stocks. Stock A is very volatile. So the price of stock A could be 100 today and it could be 120 tomorrow. And then it could be 90 the third day. Versus the second stock, if it's at 100 today, tomorrow it's most likely going to be between 101 to 99. So it doesn't change much. So in which case is the option going to be more expensive? When the price of the underlying fluctuates a lot or when the price of the underlying is very stable? So when the underlying price fluctuates a lot, in that case, remember from this slide, the buyer of the option has the upside. So if the underlying is very volatile, where is it? If the underlying is very volatile, this is the entire range of values. So the buyer could potentially make a profit till here. But if the underlying is not very volatile, if this is the range of values of the underlying, then the buyer is not going to make a lot of profit. So therefore, the seller is going to not ask for that much premium. But then if the underlying is very volatile, if the range of values of the underlying could be much wider, then the price that the buyer of the option, the profit payout to the buyer of the option could be very huge. Therefore, the premium that the seller will ask is going to be higher. Okay. Now, what other characteristics? So we discussed duration, we discussed volatility, we discussed difference between price of underlying and price of strike. What other characteristics do you think are relevant? Okay, the rest of the characteristics are not that straightforward. So let me show the slide in front of you. So we already saw strike price minus current price. Duration was already pointed out. We saw volatility. So basically, these four were covered. Now, obviously, the type of option has a say, whether it's a call option or a put option. So, that's evident. Now, Nitesh also mentioned about the style of expiry, whether it's American style expiry or European style expiry. So, if it's an American style expiry, you can exercise your right to buy or sell. The buyer of the option can exercise his right on any date between today till expiry date. So therefore, the price of the option is going to be higher. Versus an European option, in which case you can only exercise exactly on the expiry date. Now, what happens in case of dividends? In case of dividends, if you hold a stock and a dividend is paid out, the stock price drops by the amount of the dividend, but then the person holding the stock gets the dividend into his account, the money into his account. So there is no net difference in his account balance. So if the stock price was at 110, a dividend of 10 is paid out, the stock price goes down to 100, but then the 10 baht or 10 whatever is the currency goes into his account. So there is no difference in his account. But say someone holds an option. Say I hold a call option with strike 110. Now after the dividend, the likelihood of the underlying being over 110 has reduced. For the buyer of the call option, the probability that the underlying will end above 110 has reduced because the dividend has decreased the price of the underlying. So therefore, if there is a dividend in the future, the price of call options will decrease. If there is a dividend in the future, the price of put options will increase. So this is clear how dividends affect option prices. Because the thing is, the option holder, only the people who hold the stock will get the dividend into their account. The people who hold the option will not get the dividend money into their account. So therefore, the call option price will trade lower because the underlying is going to drop on X dividend. Okay. Likewise, if interest rates go up.
Can I give an example for dividend to make it more, because it's slightly tricky most of the time. So in case of dividend, so if you have a 100 baht stock, okay, it's trading at 100 baht, and the company has decided that they will be giving the dividend of 5 baht, okay, so 10 days from now, and the option expiry is beyond 10 days. So it's say end of the month, say 25 days from now. So in that case, you have the $5 that you're paying as a dividend, so that you will be paid as dividend. So that will be reflected in the stock price, right? So the 100 baht stock will actually become a 95 baht stock, right? If nothing else changes, just because of dividend. So that means the underlying price that we were seeing is reducing. So that means the payoff for the call option buyer is reducing, right? So that's why your call option premium will also increase quite a bit and decrease quite a bit. So yeah.
Okay. So the amount by which it should increase or decrease, that's another science. Basically, you need to look at the deltas and expected dividend amount. So we'll touch upon those slightly further on later in the day. Now, how does interest rate affect the pricing of option? Well, if the interest rate increases, your expectation of future price of the underlying increases. F is equal to S e to the power RT. So as R increases, your future price increases. Now, if the future price increases, you would therefore pay more for a call option, because the probability of a call option ending in the money will increase if the underlying price increases. Therefore, as interest rates increase, your option prices will increase. Now, stock lending and borrowing, how does that impact option prices? That's slightly trickier. So basically, when you hedge your options using the underlying, now if the lending and borrowing rates, so if you want to short sell the underlying to hedge against an option position, now if the borrowing rates are higher, then you would not buy put options, because you would not sell put options, because if you sell put options, you'll have to sell the underlying. And then borrowing rates are high, therefore selling the put is difficult. So stock borrowing and lending rates affect option prices in a bit of an indirect way. Okay, so amongst all these inputs, option strike, expiry date, underlying price, interest rate, dividends, option type, option style, all these are known to everyone in the market. So if you say we are trading an option in the exchange, an SET 50 option in the market, 1,200 call option, for example, expiring next month. Now, all of us know the strike price, all of us know the expiry date, all of us know the current underlying price, all of us know the current interest rate, all of us know the dividends that are expected, all of us know whether it's a call or a put, all of us know that whether it's an American or European. So all of us know that. So what is the difficult part in pricing the option? Because all of us know 1, 2, 3, 4, 5, 6, 7 out of the 8 inputs. The tricky part is judging the volatility of the underlying. Now, there are different pricing models involved. So most of us might have heard about the Black-Scholes pricing model. So what the Black-Scholes pricing model does is, it says that the volatility of the underlying is always stays constant. So basically, the way these different pricing, you must have heard about all these different pricing models. Some of you must have heard about the Black-Scholes-Merton, some of you must have heard about Derman-Kenney model or the Heston model. So the way the different pricing models differ is the way in which they model the behavior of the underlying. So you need, so how do you decide which pricing model to use? So if you feel that the underlying has a constant volatility, you use the Black-Scholes. So to price SET 50 options, which model should you use? Depends on the characteristic of the underlying. So if there are dividends involved, so that's the Black-Scholes-Merton model. Now if, in addition to constant volatility, you have a few price jumps in between. So while the volatility is constant, the daily price change volatility is constant, but then in between you have a few jumps. In that case, you should use the Merton jump diffusion model. So while the derivation of these pricing models is quite elaborate and quite lengthy, but then what I thought would help is giving a snapshot which would say that which pricing model to use in which scenario. You could use any tool available in the market, and then you could, within the tool, you would say that, okay, instead of Black-Scholes, let me use CEV model. When do you use a CEV model? When you feel that the volatility is a function of the underlying. What is this? Constant elasticity of variance. It means that when the market, during a bear market, the volatility is high. During a bull market, when the market goes up, it goes up quietly and slowly. When the market tumbles down, it falls with a lot of high volatility. So if you think that is the characteristic of the market in general, then you use the CEV model. So in your, while pricing your options in your trading tool, just go to the drop down and select the CEV model as the pricing methodology. Or if you think that volatility is not just a function of the current price of the underlying, but also the time to expiry, then you use Derman-Kenney. If you think volatility itself is difficult to predict, the volatility of the stock could be 1% today, it could be 20% tomorrow, it could be 5% day after, annualized. In that case, you use Heston. So these are different pricing models. Which one you should use depends on how you feel is the characteristic of the underlying. The price changes in the underlying, what is the, how the price changes in the underlying. Based on your expectations of the same, you use the relevant pricing model. Okay, so till here is clear to everyone, right? Can we have a few quiz questions in the middle of the day? Okay, so the next part of the session is. Rajib, there was a question. Yeah, sorry. Okay, so there is a question from a member of the audience. He wants to know how does the interest rate affect the pricing of options? Okay, so at a very crude and at a very simple level, if interest rates increase, then you expect that the future price of the stock will increase. If interest rates increase, the stock price in the future has to be higher than what it was expected to be earlier. So if the future price of the stock has increased, in that case you would therefore price your call options more expensively. Because if the future price of the underlying has gone up, then the likelihood of a call option ending in the money has increased. Remember the payout diagram for a call option? If the underlying ends up higher, the payout is higher. Therefore, if the interest rate increases, you expect that the underlying price to go up in the future. So therefore, your payout from the call option will increase. Okay. Regarding how stock borrowing rates impact option pricing, this is slightly trickier. Very few people use stock borrowing rates in their pricing of options, but then if you want to do things like market making on the market, on the options market, for example, you have to take care of each and every intricacies, so that's why I put it here. So what it means is, if the borrowing rate is high, what is stock borrowing rate? So if you want to short sell in the market, you have to borrow from someone to short sell, right? So you want to short sell stocks on Google. So you have to borrow Google stocks from someone and then sell it in the market without having it. So if you buy a call option, how do you hedge yourself? If you buy a call option, you hedge yourself by selling the underlying. So if your bet is on the volatility of the underlying rather than on direction, so you buy a call option, you hedge it by selling the underlying, your exposure is to volatility. Now in that case, when you buy a call option and sell the underlying, if the stock borrowing rates go up, you would be less willing to sell the underlying and short sell. Therefore, call prices will go down and put prices will go up. Because you could trade options in a variety of ways. You could trade options as a bet on direction, as a bet on volatility, as a bet on time value for hedging. It could be a volatility spreads, it could be a pure ARBs, it could be a bet on correlation, it could be a bet on dividends, it could be as a tool to borrow. Not all option strategies are bet on directions. Now, because a lot of option strategies are bets on volatility or correlation or various other aspects, therefore, when you buy an option, in a lot of cases, you hedge your delta exposures by selling the underlying. Now, when you sell the underlying, if the borrowing rates go up, you would be less willing to sell the underlying. Therefore, you would be less willing to buy calls. Yeah, the way the stock borrowing rates impact option pricing is a bit tricky, and then the exact mathematical way of handling it is even more trickier. You actually treat them as false dividends and so on. So it's somewhat complicated. If you want to get into this topic in detail, you could probably join our 4-month course as well. So
I think we can share some references, share some links.
Yeah, so what I can do is at the end of the course, related to each of those topics for detailed studies, we can share some of the reference material. Okay. Now, related to why are all of us here? Most of us, I believe, want to know what are the different trading strategies that we can implement. Everyone eventually wants to see the money. So, what are the different strategies possible? So, we have categorized all the strategies into different groups. The first group is directional. It's very easy to understand directional based strategies. So what is directional based strategies? Wherein you buy options and make a bet on the direction of the market. You say that I think in future the market is going to go up, the market is going to go down. So based on that, you buy or sell options. Now if you make a very simplistic trade, what you could do is you could just buy call options or sell call options, or likewise buy or sell put options. That's the very simplistic way of making a bet on direction. But then you could do a lot more. Why just buy a call option or sell a call option when you could protect yourself, do it much better? How could you do it much better? What's the problem with buying a call option? Remember this graph? You have to pay a premium. So if you feel that in the future the market is going to go up, you buy a call option. But then if you do that, you pay a premium. If you feel that in the future the market is going to go up, you could do another thing. You could sell a put option. When do you buy a call option? When do you sell a put option? Because in both the cases, if the market goes up, you make money. If the market goes up, you make money by buying a call option or by selling a put option. So what do you do? Well, one answer is it depends upon your view on the future volatility of the underlying. If you think that the option prices are very expensive right now, in that case, you don't buy a call option, you just sell a put option. If you feel that the option prices are cheap, then you buy the call option rather than selling the put option. So depending upon your view of the future volatility versus what the market is pricing volatility as. So basically the premium that you see here is a function of the volatility that the market expects in the future. Now if the market's expectation of volatility is high, the premium is going to be high. Now if the market's expectation of volatility is low, the premium will be low. So therefore you will buy a call option when the premium is low. But if the premium is high, you will rather sell a put option. Okay. Now, if you just buy a call option, you still pay the spread. So what you could do is you could do combinations of options. Why just limit yourself to just one option? You could trade multiple options. You could buy one option and then sell another option. So if you buy a call option with a strike price of 90 and then sell another call option with a strike price of 110, so you make profit as long as the underlying goes above 90 and stays till 110. After 110, you neither make a profit nor make a loss. So what is the benefit of doing this, of making a bull spread? The benefit of making a bull spread is you pay some premium to buy one call option, and then you sell another call option, therefore your total, by selling another call option, you earn the premium. So the premium that you paid to buy the call option, you make back some of it by selling another option. So you could just buy the 110 call option, but then if you sell the 120 call option too, then the amount of premium payout reduces, and then you are still net bullish on the market. Likewise, if you want to be bearish, you just sell the lower strike, buy the higher strike. It doesn't matter whether it's a call or a put. So if you buy a 110 call and sell a 120 call, it's a bullish view. Likewise, if you buy a 110 put and sell a 120 put, it's still a bullish view. So you just draw two payout diagrams, add both of them, and then you'll see that as long as you are buying the lower strike and selling the higher strike, it's always a bull spread, which means it's always a bullish view in the future. So you could do that exercise. It doesn't matter whether you are doing with two calls or two puts. As long as you are buying the lower strike and then selling the higher strike, it's always a bull spread, bullish view. Likewise, as long as you are buying the higher strike and selling the lower strike, it's always a bearish view. Okay. Now, if you have a view on the future volatility of an underlying, so you think that I don't know where the price is going to end up at, but I know that there is a lot of uncertainty in the market. If you feel that the amount of uncertainty in the market is going to go up or go down, and then you want to make a bet on that, how do you do that? Using traditional set of financial instruments, you will not be able to make a bet on future uncertainty or future volatility. So how do you make a bet on future uncertainty or future volatility? Well, options are the only instruments available in the market to make a bet on volatility. So So what does this mean? So say there is a central bank decision that is expected, or say the Fed or the ECB is supposed to make a big decision, or say a company is slated to make an earnings announcement a few days from now. You don't know which way the prices are going to deviate, but then you know that in its annual conference, Apple announces something. After the announcement by Apple, either the prices will go up a lot or will go down a lot. So you have a bet on the volatility in the future. Now, how do you trade your view? So how do you express your view on volatility? This is the only instrument available in the market with which you can express your view on volatility. If you have a view on volatility, there is no other instrument in the exchange to express your view. Now, how do you express your view on volatility using options? Well, one thing that you can do is you could buy both call and put options. What will happen when you buy both call and put options? The payout will be in the form of a V like this. So if the market goes up, your call option will make money for you. If the market goes down, your put option will make money for you. So if you have a bet on volatility, if you feel that the volatility is going to be very high in the future, which means that you feel that the uncertainty in the future is going to be very high, what do you do in such a scenario? You just buy both the call and put options. So whichever way the market moves, you make money. Likewise, but the problem with buying both calls and puts with the same strike is you have to pay a lot of premium. You pay the premium for the call, you pay the premium for the put, so the amount of premiums that you pay is quite high. So what you can do instead is, you could buy a call option which is slightly out of the money. What is out of the money? If the underlying is at 30, you buy the call option with strike 40, and then you buy the put option with strike 20. So if the underlying goes above 40 or goes below 20, if the uncertainty is huge, if the volatility is huge and then it moves a lot, ends up above 40 or below 20, then you make a lot of money. And plus, because you bought call options with a strike of 40 when the underlying was at 30, you bought a put option with a strike of 20 when the underlying was at 30. Therefore, the premium that you paid was much lesser. Oh, what time is the break? Hi, Vanita. What time is the break? This is time for the break? Okay. Okay. So I think we have a 10-15 minute break and then we'll convene again after that. Okay. Hello. Yeah, hi. Welcome back, everyone. I hope it was a nice, good break for everyone. Okay, so we were discussing how to exploit the benefits that option instruments provide us. So what are the ways in which you can exploit the benefits that options provide us? We can use options to make views on the direction of the market and trade them. How do you do that? We just saw how to create bull spreads and bear spreads and so on. Now you can also make bets on volatility. The most basic way of expressing a bet on volatility was buying straddle, strangle. There are way more complicated products than these actually. So you could actually generate a variance swap and so on, but then I would leave that aside for now. Now, a gut is similar to a strangle, but then you use the in-the-money options rather than the out-of-the-money options. What does this mean? So if the underlying is currently at 1,000, you would buy a 1,010 put and a 90 call. And then in case the market moves either directions, you make a profit. There are other ways of expressing views on volatility. There are strategies called butterfly, condors, and iron butterflies. Now, how many of you have heard about option butterflies, option condors? If anyone has heard about option butterflies, okay, one person. Okay. So basically, in case of a butterfly, what you do is you say that if the underlying ends within a particular range. So if the underlying ends between 90 to 110, I'm going to make a profit. If the underlying ends outside 90 or 110, I'm neither going to make a loss or make anything. So how do you make a butterfly? You buy the 110 call, you buy the 90 put, and then you sell the 100 call and 100 put. So basically, it's a short straddle. In case of a short straddle, you sell the put and call of the same strike. So this is equivalent to a short straddle, but then you buy the wings. By buying the wings, I mean you buy the call, out of the money call and out of the money put, so that if the underlying were to really move far away, you don't make a loss. Okay, just to recap, in case of short straddle, you sell the put and sell the call. So what is your payout like? Your payout is like this. Okay, in this diagram, your payout would be like this. If you sell a call and sell a put, your payout will be like this. Now, in this case, if the market were to really make a big move, you will lose a lot. If the market were to make a big move, you will lose a lot. So in case of a short straddle, if the market were to move a lot, you will lose a lot. So what do you do instead? So you buy the 40 call, you buy the 20 put. So because you bought out of the money calls and out of the money puts, therefore your loss is capped. So that is what a butterfly is. That is what an iron butterfly is. Pure butterfly actually exists, is created by buying and selling only calls, or buying or selling only puts. So in essence, the payout of a butterfly and an iron butterfly is just the same. So in case of butterfly, what do? You buy the 90 call, you sell 200 calls, then you buy the 110 call. So the payout of that is equivalent to buying the 100 trend strangle and then selling the 100 straddle. Okay, so in case of butterflies and short iron butterflies, your view is that the market is going to stay close to 100. Your view is that the market is going to stay close to 100, and then therefore you feel that there isn't much uncertainty, the market is going to stay close to 100. Therefore, but in case the market moves a lot, you don't want to lose. So what you do is, you make a butterfly. In case you, okay, let me start once again. If you feel that the volatility and the uncertainty in the market is going to be less, you sell a straddle. Now, but then if you sell a straddle, you could have huge downside losses. Huge losses if the market moves a lot. So what do? You could make a butterfly, in which case your losses could be limited. Now, there is another similar instrument called the condor. What happens in case of a condor? In case of a condor, you sell the 90 put, you sell the 110 call, you buy the 120 call, and then you buy the 80 put. So what happens in that case? If the market stays within 90 to 110, you make a profit. If it goes outside 90 to 110, you start making a loss. But then after 120 on the upside or below 80 on the downside, you don't make any, your losses are restricted because of the long option positions. Okay. Now, not all option strategies are based on making bets on direction or volatility. Some option strategies try to make a bet on the time value that exists in the option. So how do you make a bet on time value? You could directly say that, okay, with 10 days left to expiry, the time value in the option is equal to, say, 10 baht, and then you feel that that is just too much premium that the seller is asking, so you can just sell it. You feel that that's just too much of a time value, you sell it. So that's a very direct way of expressing views on time values. Now, what are some of the more sophisticated ways of expressing views on time values? One, you could make a calendar spread. What is a calendar spread? You say that the time value in the October expiry options when compared to time value for November expiry options are much higher. So you are making a relative view on the time value of two different options. So that is a calendar spread wherein you are making relative bet, a bet on the relative values of time values of two different expiries. So one, you can make a direct bet on the time value of the options expiring in October. But then a more sophisticated thing to do would be looking at historical data, saying that whenever the time value of options expiring in month 1 versus options expiring in month 2, the ratio deviates more than a certain level, it is likely to converge back. So what do? In that case, you make a bet on the relative difference between time value of options expiring in two different expiries. Now, what happens when you sell an underlying? When you sell a stock, you get cash into your account, and then you can keep earning interest on it. When you sell something, you get money, you can earn interest on that. Now, if you sell an underlying, and if you sell a put, your position is actually totally hedged. How is that so? You sell a put. What is the payout diagram when you sell an underlying? This is the payout diagram when you sell an underlying. Because when you are long an underlying, this is the payout diagram. So when you are short an underlying, this is the payout diagram. So your net payout is flat. So you can keep earning interest on both of them. So you sell the put, you sell the underlying, you sell very far in the money and puts, you sell the underlying, you keep earning interest on that. Now, a lot of people actually use options as a hedging tool. How is that so? So you have a exporter. What is their risk? Their risk is that the currency might strengthen or it might weaken. It could be either way. Or a manufacturer's risk is that a particular commodity could become more expensive. In which case, what could they do? They could buy options on that commodity. They would say that irrespective of whatever is the price of gold in the future, I would like to buy gold tomorrow at 1,400 or 1,700. So a lot of people use options as a hedging tool. So you take a student loan. How do you hedge yourself against the student loan? You buy you go abroad to study. You take a student loan. How do you hedge yourself against that? You buy call options on the foreign currency on which you took your loan. You buy out of the money call option. You have invested a lot of money into the stock markets. How do you protect yourself against the downtrend in the stock markets? You buy protective puts. You buy out of the money puts. So in case the market drops down drastically, your entire life savings which you have put into the stock markets should not wipe your wealth. So what you do is you buy put options, out of the money put options. So a lot of people use options as an insurance to hedge themselves against price moves which are opposite to what they would love to have. Now there are certain strategies as well. So if you already own a stock, then you can sell out of the money calls. What will happen? You can keep earning the premium on the call, premium that you buy selling the option. Sell an out of the money call, earn the premium, and then if the market goes up, you anyway profit from your stock. So this is what I'm referring to. If you sell a call option, this is the loss. You start losing if the market goes up. But what if you already own the stock? If you already own the stock, you are not going to lose here, and then you could keep earning the premium. So if you already own a stock, and then you feel that the stock is probably not going to end beyond a certain value. So currently the stock is trading at 100. You feel that the stock is probably not going to cross 140. In case you have already, if you already own the stock, you just sell calls with a strike of 140. What is your risk? Your risk is that the stock might cross 140. If the stock really crosses 140, because you already own the stock, you are going to profit from that leg. So therefore, it's a way of enhancing your returns by selling call options when you already own the underlying. Now, in case of Thailand, stock options are not that prevalent, but then what you could do is if you have a stock portfolio, you own a lot of stocks, in which case your exposure is somewhat similar to the index itself. You could sell out of the money index options. If you have out of the money index call options, if you already owned a huge number of index components. Similarly, similar to covered calls, you have covered puts as well. So if you are short underlying, you can sell out of the money puts. So it's similar to covered calls. So these are covered option rights. Okay. So in case you own a stock, what is your risk? The risk is that the market might go down. So in which case you buy out of the money puts. And because you are already own the underlying, you can sell out of the money calls and earn the premium from selling those out of the money calls. So these are known as fences or collars. So you already own the underlying. To protect yourself against losses because of drop in price of the underlying, you buy the puts. But to buy the puts, you have to pay a premium. So how do you protect yourself? How do you ensure that the fact that you are paying so much premium doesn't cause a loss for you? How do you do that? You sell out of the money calls. Now, when we looked at time value strategies, we said that either you can make a direct bet on the time value. You can say that the time value for the options expiring in October is huge. And then you can make a bet on it. So it's a one-directional bet. Either it could turn out to be true or it could turn out to be false. But then as most of you already trading in the markets would know, making a direct bet in the market is not likely to be that successful because it's your bet versus someone else's bet. I said that the time value looks high. You said that the time value looks less. It's my bet versus your bet. But then when you do a bit of mathematical, statistical research and try to find relationships, relationship-based trades are much more likely to be profitable. So you say that relatively, the time value in October looks much higher than November. And then based on historical values, I see that this ratio is likely to converge. So that is a much more structured and organized way of looking at things rather than making a direct view. So similarly, for volatility, instead of making a direct bet on volatility saying that, okay, I'm going to buy options because straddles or guts because I feel volatility is going to be higher. So that's one way of looking at things, by directly making a bet on volatility. The other way is by making a bet on relative volatilities. So you say that I'm going to buy certain options, I'm going to sell certain options, and then my bet is that the options that I'm buying, I'm expecting the volatility of those options to go up. So basically, for example, in SET 50, you have options with strike 1,200, you have options with strike 1,300. Now you say that I feel that the options with strike 1,100 are priced using a much higher value of volatility than the options with a strike of 1,200. So your bet is on the relative volatility used to price different options. Instead of making a direct bet saying that, oh, I think the volatility used by people to price options is high, what you do is you say that I am making a bet on relative difference between volatility of different options. So you say that 1,100 volatility looks high, 1,200 volatility looks low. So you buy 1,000, you sell 1,100 option, you buy 1,200 option. So I'm not sure how many of you have heard of this term risk reversal, etc. But then in the option OTC markets, these are very common and popular terms. So basically, if you have a bet on the skew of the vol curve, so this is one topic that we have not touched upon so far. So basically, you use different levels of volatilities for pricing different strikes. Now you say that I have a bet on the skew. So in which case you say that I think the out of the money calls are going to be more expensive in the future than the out of the money puts. Why is this going to happen? If in general the view of the market, if most participants in the market feel that an bullish upswing is more likely than a bearish downswing, then more people are going to buy out of the money calls, and fewer people are going to buy out of the money puts. Therefore, if you feel that in the future the trend in the market is going to turn more bullish than bearish, then you could start buying risk reversals. Some people also call them as risky. So what is a risk reversal? More bullish views in the future than bearish views. So this is one of my most favoritist topics, but then I usually take around 30 minutes just explaining forward volatilities. So basically, in short, it means, okay, let me try to approach it in a different way. You have options expiring in October, you have options expiring in November, you have options expiring in December. The options expiring in October are priced using a volatility of 25%. Options expiring in November are priced using a volatility of 26%. Options expiring in December are priced using a volatility of 27%. 25% October, 26% November, 27% December. Now, which options should you buy and which options should you sell? Well, it depends upon the, you don't say that 27 in December is too high or 25 in October is too less. Because 27 in December actually includes 25% till October and something more. So December, an option expiring in December already includes the time period from now till the expiry date of October, so which is 25% volatility. So it's a somewhat complicated concept. I would really need some time to explain this, but then in essence it means that you compare the volatility in the future. So an option with a volatility of 26% in November means that people are pricing volatility between the end of October to end of November as 28%. If the volatility till October is 25%, volatility from now till end of November is 26%, it means that volatility from end of October to end of November is higher than 26%. So forward volatility, what it does is it says that based on the implied volatility of different options. So an option expiring in September, an option expiring in October, option expiring in November. Based on those two options, I find out what is the market's anticipation of volatility in a future period, starting from the last day of October to the last day of November. So you calculate the forward volatilities for each of those options in the future, and then you make a bet based on that. It's hugely profitable. I think we made profits on forward volatility for a very long time in a lot of geographies. Okay, so conversal and reversal. What happens when you buy a call and sell a put? You bought this call, you sell the put. If you add both of them up, it's just a straight line. Buy call, sell put, add both of them up, it's just a straight line. Now, if you can buy a call, sell a put, and then it's equivalent to the underlying. And then if you can sell the underlying at a higher price than the implied underlying price. So when you buy a call and sell a put, this is equivalent to an underlying. So this is called as the synthetic underlying. Because this is not the actual underlying, this is the synthetic underlying. You buy the call, sell the put, it's a synthetic underlying. Now if you can sell the actual underlying at a higher price than the synthetic underlying, then that's a profit for you. You buy the call, sell the put, that's equivalent to some underlying. Now you sell the underlying, actual underlying at a higher price than this. So you make a riskless profit. So this is an arbitrage. So that's why I've mentioned this as a simple arbitrage. So synthetically long underlying. What is a synthetical long underlying? You buy a call, you sell a put. If you buy a call and you sell a put, this is equivalent to a synthetic position in the underlying. Now you sell the underlying at a different price than the synthetic underlying. That's a profit for you. Likewise, you have something known as the reversal. Similar to conversal, you have something known as the reversal. What is reversal is you have a synthetic long underlying, you sell the underlying. What is a conversal? You basically sell a call and buy a put. When you sell a call and buy a put, what do you have? You sold a call, you bought a put. This is you buy a put. So when you add the buy a put to this, when you add a buy a put to this, your net total payout is like this. Sell call buy put is like this. What is this? This is equivalent to being short the underlying. Sell call buy put is equivalent to being short the underlying. Now, using options, you have sold the underlying. Now, if you can actually buy the underlying at a better price than this, you are going to make a profit. So, in conversal, if you can buy the underlying at a lesser price than the synthetic underlying that you generated by trading in options. So by trading in options, you are equivalent to the underlying. By selling calls and buying puts, you are equivalent to the underlying. And then if you buy the equivalent to a short position in the underlying. Now if you can buy the actual underlying lower than that in the market, you make a profit. So any questions with regards to conversals, reversals, riskies, forward volatilities, which I believe is somewhat difficult to explain without the proper slides in 5 minutes. Is there a presentation on forward volatility with you? Huh? Okay. So any questions on forward volatility, risk reversal, conversals, reversals? Covered calls, covered puts, fences, interest play, volatility strategies. When to use which strategy? Okay. There is one more very interesting concept. It's called dispersion. Stock options. Do you have stock options in Thailand? Or just index options? Only index options, no stock options. Okay. So basically in places where you can trade stock options, there is this very interesting strategy called as dispersion. So what you do is, you say that the index is a, so in future, you are most likely to have stock options in Thailand as well. So in which case, dispersion will be a profitable strategy for you too. So what you do in case of dispersion, what is the concept of dispersion? You actually make a bet on the relative amount of correlation of the components in the index. What is that? An index is composed of a variety of stocks. Now, the implied volatility of index options should therefore be linked to the implied volatility of the stock options. Now, so this is what it is. If you have a stock with volatility sigma 1, stock 2 with volatility of sigma 2, then this is the value of the volatility of the index composed of two stocks, where rho is the correlation coefficient. Now, based on the value of rho, the value of index volatility will change. Now, if the degree of correlation of the stocks is high, then the volatility of the index is going to be high. So if this value goes up, this is going to go up. What is increased correlation in the market? Increased correlation means that all the stocks move in sync. So if one stock goes up, the rest of the stocks go up as well. So basically, increased correlation means that the stocks move much more in sync. So what you can do is, you could actually create a graph of historical correlation of the components in the index. So when you create a graph of the historical level of correlation of the components in the index, you find out what is the range of correlation of the components in the index. So you say that the correlation typically lies between 0.2 to 0.6. Now, it actually goes up, the amount of correlation actually goes up when there is panic in the market. When there is panic in the market, what happens? People sell stocks en masse. Everyone is scared, all the stocks move in sync. When the market goes up, it typically goes up slowly and quietly. Once people selectively buy stocks, one stock goes up, another stays there, a third stock might go down. But when markets fall, all stocks fall down uniformly. Therefore, correlation is high when the market is dropping. Correlation is low when the market is stable. So you said based on the amount of historical correlation that you see, based on the current perception in the market, you say that whether this is the right time to sell correlation or buy correlation. So in advanced option trading markets, people track the amount of correlation of the components quite aggressively. So how do you decide whether a particular value of index volatility used for pricing index options is high or less? What you do is you also track the amount of correlation of the components. If the correlation you expect it to go up, you will be pricing up index options more aggressively, more higher. If the correlation is expected to go down, you price index options cheaper. Now, if you expect index volatility to go up, one thing you can do is, if you expect correlation to go up, what will happen? The index volatility will go up. If you expect index volatility to go up, you buy index options. But then, if you want to make a relative bet, you buy index options and sell stock options. So that is one thing that you can do. Dividend plays. Well, if you have a bet on the dividend, then you can trade that using options. You say that I think the dividend in the stock or the dividend of all the components of the index is going to be much higher than what the market perceives it to be. The market thinks that the dividend is going to be 1%, but then you think that the dividend is going to be 1.5% or 0.5%. Then you can express that view using options. You buy call options, sell the underlying. Your exposure is to dividends. So in case the dividend turns out to be lesser than what the market perceived it to be, you make money. So you could express views on dividends directly using options. But another way but that's a very plain, straightforward way of expressing views. What is a more sophisticated way of expressing views on dividends? You could actually make bets saying that if the underlying were to stay at 1050, the dividend is going to be 1%. But if the companies are not doing well and then the index drops to 950, if the index drops to 950, I expect the dividend to be 0.8% only. Or basically if the companies are not doing well, they are not going to pay dividends. Therefore, the dividend that companies pay is a function of how well the stocks are doing. It's a function of where the market is. So you could price different dividends, different options using different level of dividends. So this is known as skew dividends, which not a lot of people trading options use, and then therefore people who do better. Dividend plays. So it's basically making a bet on dividends. You buy the underlying and then you sell deep in the money calls. Now, underlying in November. So what is that? You sell call, buy put in November. So what is your net position? Your net position is equivalent to being buying the underlying in October, selling the underlying in November. Now, what should be the price of this? This should be the price, this should be equivalent to holding the underlying for 3 months from October to November. Now, if you can execute a jelly roll cheaper than what your bank charges you, it's again a good trade for you. There are combinations, so you could actually combine a box and a jelly roll. What is the combination of a box and a jelly roll? You buy the underlying synthetically at 90 in October, you sell the underlying synthetically at 100 in November. So it's equivalent to borrowing 10 bahts for 1 month. So what's the price for borrowing 10 bahts for 1 extra month? So with that, we have completed a very basic overview of the different categories of option strategies, how you can use it to express views on direction, volatility, time spreads, volatility spreads, correlation, dividends, use it to borrow money from the market, and so on. Or use it as a basic hedging tool too. So thank you, Mercy, Danke,
we
Krazi,
can actually,
and Khop Kun Mark.
Yeah. So what we can do is, so what we have thought about is that we can go through a question answer round. So we would be glad to go through the queries of yours. In case otherwise, we can continue with another presentation. So you can pick your choose. So anything that we discussed so far?
Any questions? Or otherwise, we'll start asking questions.
Okay, okay. One question at least? Someone? Option 4.
Okay, so we'll move to the next session, which is somewhat, this is the most critical aspect. Everyone, when they come to us in our course, everyone wants to learn about strategies. But at the end of the day, what makes money is not strategies, but a proper risk management. Understanding where your risks are, where your rewards are, and how to manage the risk-reward profile, that is where your profits are. Your strategies don't make money, a proper risk management makes money for you. So we think it might be good to very quickly introduce you to different types of risk aspects, risk parameters, and then how to manage those. So how many of you in the audience have heard about delta, vega, gamma, theta of options? Okay. Okay. So a few of you have heard about delta, vega, gamma, theta of options. But then if you are to, you can use those to trade. And especially in markets which are new and naive, you could use delta, vega, gamma, theta, rho to trade. But then as markets become more sophisticated, as markets become more contested, more people enter into the market, you would have to look into not just the first order risks, which is delta, vega, gamma, rho, but then second order risks, which are basically second order derivatives, which is how does delta itself change with respect to change in price of the underlying, for example. But third order risks and certain other risks. So today we will very quickly, if you ask me personally, this is the most important slide of the day. Being able to understand where your risks are and how does your risks change with changing market conditions. So that is the most critical part. You could very well initiate a position, but then how do you sleep peacefully at night with that position if you don't know where your risks are? So if you know what your risks are, you could sleep peacefully, you would know where your risks and rewards would be. So let us start with the very basic ones. Okay, even before I start here, how did I arrive at this? The first order risks. Remember we mentioned the characteristics involved of options which are used in pricing options. So basically the pricing of any financial instrument is based on the characteristics of that instrument. Now based on the characteristics of that instrument, if any of those characteristics change, your price is going to change. Now therefore, you need to know how your portfolio value will change if any of those characteristics change. So one of them is delta, which says if the underlying price changes, how is my option price going to get affected? Another risk metric is called as vega, which says how does the price change if the characteristic known as volatility changes. Theta says that if I keep holding this position, how much will the price of the portfolio keep changing on a daily basis? Remember when we looked at the different inputs to the option pricing models, different characteristics used for pricing options, we said that interest rate affects the prices of options. Therefore, any change in interest rate is going to affect the price of the option. Therefore, the change in option price with respect to change in interest rate, it is known as rho. So let us very quickly look at least the first order risks. And then if we have time, we will look at second order and third order risks. So this is a graph of price of call option versus price of underlying. So what do we have here? This is a call option. As the underlying price increases, the call option price will increase. As the underlying price increases, the price of the call option will keep increasing. That's pretty much self-evident and rudimentary. Self-explanatory, it's explanatory why the call option price will increase when the underlying price increases. Now, delta is defined as the rate of change of option price with regards to change in the price of the underlying. Now, if the option price changes by 0.5 for every 1 point change in the underlying, then for every one option that you have, you could hedge yourself using 0.5 underlying. So therefore, it's called as the hedge ratio. Because if the rate of change of the option is 0.5 of that of the underlying, for every option that you have, you can hedge yourself using 0.5 of the underlying. Therefore, it's also called as the equivalent position in the underlying. So this is the basic definition, rate of change of price of option to change in price of underlying. Now, a fourth definition, this is the most critical definition. Delta is also the probability of an option finishing in the money. So if an option has 0% probability of ending in the money, are you going to pay money for that option? Probably not. If you're not going to pay money for it, is the price of the option going to change when the underlying price changes in value? Probably not. If it's already worth 0 and it changes to 0, so the price change is also 0. Now, if something has a 100% probability of ending in the money, now if the underlying changes by 1 point, what is going to happen to the price of the option? It's going to change by exactly 1 point because it's almost equivalent to the underlying. So to highlight this case, let me use an example. Say the underlying is currently trading at 500. Now you have a call option which has strike of 50. Now that's almost equivalent to being the underlying. The call option which has strike of 50, when the underlying is at 500, is almost equivalent to a position in the underlying. Because when the underlying goes from 501 to 500 to 501, the option price is going to go up by 1. It's almost equivalent to the underlying. When the underlying goes from 500 to 499, the option price is going to drop by 1. So the price change in the option is going to be 100% of the price change in the underlying. So delta, the most important definition if you ask me, is the probability of the option finishing in the money. If something has a 100% probability of ending in the money, the price change on when the underlying changes would be 100%. If something has 60% probability of ending in the money, if the underlying moves by 1 point, the option price will change by 0.6. If something has if an option has 30% probability of ending in the money, if the underlying moves by 1 point, the option will move by 0.3 points. That's clear? Okay, so I'm going to have a quick quiz session based on this fourth definition. Now, there was one more slide just prior to this, but then okay. So, what I had mentioned in that slide is delta from the Black-Scholes formula. Basically, the option pricing formula has a particular value for the options, right? Black-Scholes says that this is the value of options. So C is equal to blah, 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 blah. Now, if you differentiate that, so if you remember your calculus classes from school, so if you differentiate that with regards to the price of the underlying, the first order differential, what you will get is the delta. So you differentiate price of option by price of underlying, so DC by DS. That is delta. Now, if you differentiate the Black-Scholes formula with respect to the underlying price, the value of that equation will have the following terms. So therefore, delta is dependent on this. Now, if delta is dependent on this, we need to know how does it change with the following conditions. Delta with regards to the underlying, we already saw this graph. As the underlying price increases, the delta increases for calls. It decreases for puts. So in case of puts, the deltas are always negative. a put option will always have a negative delta. So when I say a put option which is deep in the money will have a delta of minus 100%. And a call option which is deep in the money will have a delta of plus 100%. Okay. Now the quiz part starts. How do you think that the delta of an option will change with change in time to expiry? Remember the 4 definitions? Probability of option finishing in the money. That's where the answer lies. How do you think that the delta of options will change with change in time to expiry? Okay, to answer your question, this is how the option prices will change. Option deltas will change with changing time to expiry. How do you explain this? This is a call option with strike 90, call option with strike 100, call option with strike 110. Now, as you are approaching expiry date, so if expiry is on the 30th of October, as you go closer and closer towards 30th of October, the probability of an option ending in the money will either go towards 100 or 0. But as you are very far away from expiry, so say you have 1 day to expiry, and then in scenario B, you have 1,000 days to expiry. When you have 1 day to expiry, you definitely know for sure whether 1,200, whether the underlying will cross 1,200 or not. But then when you have 1,000 days to expiry, you definitely don't know whether the underlying will cross 1,200 on expiry or not. So therefore, the probability of the underlying ending above 1,200 on expiry is much more clearer when you are very close to expiry. So when you are very close to expiry, either the probability is 100 or 0. When you are very far away from expiry, all of them will have probability close to 50%. So deltas will become progressively towards 100 and 0 as you come closer towards expiry. So this is in case of calls. In case of puts, it's just the same thing, but then you have the negative signs in front of them. So deltas, change in delta with change in time, that's very clear to you. So basically, you might have a portfolio. You might say that, okay, I want to express a view on the direction of the underlying. So you use options to express a view on the direction of the underlying. How do you do that? You use call options, put options, whatever. You build a huge portfolio of options to express your view on the direction of the underlying. So you say that my portfolio has a delta of plus 70 or plus 7,000, whatever. Now, you feel that you should make money when the market goes up, but then few days later you see that while the market has gone up, your portfolio has not made money for you. Why did this change happen? This happened because your portfolio delta changed with respect to time. So as you come closer and closer towards expiry, you will start, your portfolio delta will keep changing. In fact, this concept is known as charm. The first time I traded in the markets, the very first month that I traded in the markets, I made a loss of 20,000 euros on one day just because of charm. And my manager was very happy. He said that you will never forget about charm because you made this loss. So you might think that your portfolio is hedged. You might think that you have a particular bet on the direction of the market. But then because of charm, your deltas will change with time. Therefore, your direction bet might change without you being even aware of it. So when you are trading a huge portfolio of options, you might be trading 20, 30 different options. You might be long on one option, short on a second, long on a third. And so you might have long positions in 10 of them, short positions in 10 of them. And at the end of the day, you will say that, okay, I calculated my deltas. My deltas turned out to be plus 700. Okay, I have a bullish view, and then you go to bed. You go on a vacation, come back 10 days later, the markets have actually gone up, but then you made a loss. Why is that so? Because, well, your deltas change with time. So this is the combined visualization. This line is when you're very close to expiry. So everything is either delta 0 or delta 1. As you're further away from the expiry, your deltas become much more flatter and towards 0.5. As you come closer towards expiry, either you are delta 0 or delta 1. Okay. So that is clear. The next thing, delta versus volatility. As people's expectation of volatility in the future changes, how do you think delta would change? How do you think changing expectations of volatility in the market will affect delta? This is actually very critical, important. You might not realize it straight away because you might feel that, okay, volatility might change, the delta will be affected by it. That's a very far-fetched situation. That's way too many variables involved. How might it be relevant for me? Okay, let me give you examples. So, just after a corporate earning release, so immediately after a company announces its quarterly figures, immediately after the central bank announces its interest rates decisions, immediately after the Fed or ECB or the Bank of England makes its announcements, the implied volatility in the market changes drastically. People's expectation of volatility prior to the event is quite high because they don't know what is going to happen. No one knows what Mr. Trichet is going to speak. But then immediately after Mr. Trichet speaks, everyone knows what has happened. So expectation of volatility in the future drops drastically. So because expectation of volatility in the future has dropped drastically, therefore your portfolio delta will change a lot. And what you thought was hedged or what you thought was a bullish view on the direction might turn out to be a bearish view on the direction of the market. So how do you think volatility will affect the delta of your portfolio? Any bet? Remember this fourth definition? Probability of option finishing in the money. Does that give you some sort of hint as to how it might affect the delta of a portfolio based on change in volatilities? Well, if future expectation of volatility comes down, then you definitely know for sure whether something will be in the money or out of the money. As future expectation of volatility is high, you don't know for sure whether something will end in the money or out of the money. So probability of an option finishing in the money becomes much more clearer as volatility decreases. Your probability of an option finishing in the money reduces, is much less clearer when the volatility is high. So just to give an example, if the volatility is 5% annualized, or 0.1% annualized, the stock hardly moves. In that case, if the underlying is at 110, you know for sure that it's not going to move much beyond 110. Therefore, the 100 call is going to be in the money for sure. Now, if in contrast, your volatility is 200% annualized, in case the stock is currently trading at 110, in 1 week's time, it could be either at 90, it could be at 130. So 100 call could either be in the money or out of the money. So it's not that sure. So the probability has gone down. Therefore, delta versus volatility, this is how it is. As volatility is reduced, the deltas become progressively either 0 or 1, 0 or 100%. And as volatilities increase, the deltas move towards 0.5. So this is clear, delta versus volatility to everyone? Okay. Likewise for puts versus volatility, similar graph, just that 0 to minus 100. How much time do we have? Oh, Vanita, how much time do we have? 20 minutes? Okay. Okay. So if you buy a call option and the market is currently at 100, if you buy a call option and the market is currently at 100, then this is how your payout diagram is going to look like. If you buy a call option, the market is currently at 100, this is how your payout diagram is going to look at. Like, now, if you sell a put option with a strike of 100, this is how your payout diagram is going to look like. In both the cases, when you are exactly at 100, in both the cases, the profitability has the same line. What a minute. In both the cases, the profitability has the same line. But as you go further away, this line slopes upward, this line slopes downward. So why is the difference? The difference is because the rate of change of delta at this point of time, both of them, a long call and the same short put, had the same value. But the deltas itself were changing. In case of a long option, you get the right deltas with time, with change in price of the underlying. In case of a short option, you get the wrong deltas. The discrepancy is because deltas changes with price of the underlying. What is this known as? This is known as gamma. Gamma. So all these terms that you see, the first order Greeks, the second order Greeks, the third order Greeks, at least most of them are called, as a bunch, as a group, these are called as Greeks. When someone says that, what are the Greeks of the option portfolio, this is what they are referring to. They are referring to the risks through these terms. So they are referring to what is the delta of the portfolio, what is the vega of the portfolio, what is the gamma of the portfolio, and so on. Okay, we'll come to gamma slightly later because let me do the more critical stuff first, which is vega. If you ask me personally, option trading is actually more about volatility trading. There is no, it's the only instrument in which you can use to express a view on volatility. Option trading is the only instrument to express a view on volatility. Now, in fact, in the more advanced markets, people do not talk about option prices in terms of the prices per se, which is they don't say that, okay, this option is priced at 20 baht or $20 or 20 euros. They talk in terms of volatilities. They say that this option is priced at an annualized volatility of 25%. So they talk about an option being cheap or expensive with respect to the volatilities at which they are priced. So they would say that the option which is priced at 25% volatility is cheap. The option which is priced at 27% is expensive, and so on. They won't say that the option priced at 20 baht is cheap and then the option priced at 30 baht is expensive. So in the more sophisticated markets, that's people look at options more from a volatility perspective, and then they talk in terms of the volatilities of the options. Now, because and the greatest risk to an option portfolio is actually volatility, change in volatilities in the market. Why is that so? Because everything, all the other inputs to the pricing of an option are known to everyone in the market. Remember the different inputs to an option pricing formula? Everything is known except the volatility of the underlying. The volatility of the underlying is not known to anyone. So it's my bet on volatility versus your bet on volatility. So volatility is actually the most important input in the most important criteria to manage while looking at risks of an option portfolio. Now for the formula, Black-Scholes formula, when you differentiate it once with respect to volatility, what you get is this. Now what does this mean? It's also equivalent to the volatility of a put for the same strike. Now, if it also means that it is a function of time, it's a function of moneyness, it's also a function of volatility itself. This diagram shows how the prices of options change with respect to volatility. What do you expect? Do you expect option prices to increase or decrease when volatility goes up or down? Well, when volatility increases, when future volatility increases, your option prices are going to go up in value. That's pretty much self-explanatory and straightforward. This part is understood that option prices will go up when volatility goes up. That's because when volatility goes up, the range of prices of the underlying is much wider. And if the range of prices is much wider, the buyer of the option will benefit if the market moves in his favor. If the range of prices is wider, therefore the buyer is going to benefit more. Therefore the seller is going to ask for a higher premium. Therefore, when the volatility goes up, the range of prices of the underlying could be much wider. Therefore, the buyer would benefit more if the movement is in his favor. Therefore, the option price is going to go up. This is understood? Okay, so in case volatility goes up, option prices go up. That's because if volatility goes up, range of prices of the underlying goes up, becomes more, and therefore the upside benefit to the buyer of the option goes up. 1 minute. Huh? Oh. Okay, so assume this is the payout diagram. Now if the volatility is 10% annualized, this is the range of values of the underlying. This is the range of values of the underlying. Therefore, the maximum profit could be up till here. Now, if the volatility becomes 40% annualized, this is the range of values of the underlying. The maximum profit to the buyer has increased, and the maximum loss of the seller is just the premium. And therefore, the seller is going to ask for a higher premium. There is a reason why up till a certain level of volatility, an increase in volatility does not increase the price of the underlying. So basically what it means is, if the underlying is currently at 100, the volatility should increase by a certain amount, by at least that much, so that the 90 strike has a probability of ending in the money, the 90 put, or the 110 put has a probability of not ending in the money. So till a certain threshold probability, increase in volatilities do not affect. Beyond that, increase in volatility increases the price of an option. Okay. Now the rate of change of option price with respect to change in price of, with respect to change in volatility, implied volatility in the market is known as vega. So if you expect volatility in the future to be 20%, and then tomorrow that expectation changes from 20% to 21%, your option prices are going to change in value. The changed value is known as vega. So difference in option prices, when the implied volatility, future expectation of volatility changes by 1%, that difference in option price is known as vega. Okay, so let me very quickly skip through. So it's a pretty long explanation, so let me just very quickly come to this. So basically the crux is the vega is highest at the money. So if you have 3 options, an option with a strike price of 90, an option with a strike price of 100, an option with a strike price of 110. So when the underlying is at 100, the option with a strike price of 100 will have the highest vega. When the underlying is at 90, the option with a strike price of 90 will have the highest vega. So the vega, the rate of change of option price with respect to change in volatility, is highest for at the money option. At the money option from a little early when Nitesh gave this talk, you remember, is the option with the same strike price as the current underlying price. Okay, so one very quick question. How do you think Vega will change when time to expiry changes? How do you think Vega will change when time to expiry changes? So basically Vega is sensitivity of an option price to change in volatility. So how will 1% change in future volatility change the option price? That is Vega. Now how will Vega change when time to expiry changes? Okay, let me take two scenarios. Scenario A, the options expire 2 days from now. Scenario B, the options expire 1000 days from now. In case 1, in scenario A, if the future expectation of volatility changes from 20% to 21%, will the option price change a lot? In scenario A, if the future expectation of volatility changes from 20% to 21%, sorry. Okay. Okay, I got my first set of questions already. So in scenario A, if the future expectation of volatility, which is also known as implied volatility, if that changes from 20% to 21%, the change in the underlying won't be much because you only have 1 day left to expiry. If you have 1000 days left to expiry, if your annualized volatility changes from 20% to 21%, that additional 1% volatility will take effect every day for 1000 days. Therefore, a 1% change in future expectation of volatility will affect option prices more if the time to expiry is higher. A 1% change in implied volatility will affect option prices less if the time to expiry is lesser. So this is how it looks like. As you come closer and closer towards expiry, the vega of options decrease. So volatility and vega are much more critical at the start of an expiry cycle. So as you come closer and closer towards expiry, vega is not that relevant. It's relevant, it's not that relevant. So this graph is clear to everyone? As you come closer and closer towards expiry, there is one aspect that I didn't explain. So as you come closer and closer towards expiry, vega becomes very less and less relevant. So this is pretty much clear to everyone. As you are further away from expiry, even 1% change in implied volatility can change option prices a lot, because 1% change in implied volatility can change future price of the underlying a lot, because the underlying will be much more volatile every day for those 1000 days. Okay. The out of the money and in the money will not have any vega beyond a certain threshold, because the probabilities of those ending in the money have become close to zero. Therefore, there is no time value associated with those. And this is how it will be. Okay, one very quick question. This is vega with respect to volatility with time. Vega with respect to volatility is somewhat similar. It's basically what it means is, for a lot of scenarios, if you know how a certain Greek will be affected by change in time, you almost certainly know how a change in volatility will affect it. Because change in volatility is almost equivalent to change in time. Why is that so? If you have more time to expiry, the underlying has more time to move around. If an underlying has high volatility, the underlying buy characteristic moves around a lot. If the time to expiry is less, the underlying does not have time to move around a lot. If volatility is less, it means the underlying buy characteristic doesn't move a lot. So if you know how a change in time will affect a certain aspect of your portfolio, for a lot of scenarios, you know how change in volatility will affect your portfolio. So if you remember, delta versus time and delta versus time and delta versus volatility are very similar. This was delta versus time, this was delta versus volatility. So if you have if you are close to expiry, you know for sure which of them are going to end in the money or out of the money. Likewise, if the volatility is less, future expected volatility is less, you know which of them are going to end in the money or out of the money. If you know, if the volatility increases, it means that your uncertainty in the future increases, which is equivalent to having more time in the future, more time till expiry, because if you have more time, the underlying will move around a lot. Okay. So before I proceed much further, and then let me take a question by one of the participants. So the question is, in practice, when you perform hedging from selling options, does other Greeks other than delta matter? What is to be considered? How to hedge those Greeks? Gamma, Vega, etc. Thank you. Okay. So actually, if you remember the first slide, the first two slides, you actually need to hedge all of this. Now you cannot solve all these equations. You cannot have a portfolio where your net portfolio delta not okay, before even I start talking about those for people who are new to the options world. So your portfolio delta is nothing but your position in instrument 1 multiplied by the delta in instrument 1 and the summation likewise. So position in delta instrument 1 multiplied by delta in instrument 1 plus position in instrument 2 multiplied by delta in instrument 2 plus position in instrument 3 plus delta in instrument 3 plus and likewise and so on. So your portfolio delta, portfolio vega, portfolio theta, you can calculate all of those. But then obviously it's difficult to minimize all of them. You could probably minimize your delta and vega, but then you will not be able to minimize, say, your charm or voma or vita and so on. Now how do you do that? So what is of concern? So basically at a very broad level, at the start of the month, your vega becomes very critical. So you would not want to have an exposure to vega at the start of the month. And as you come closer and closer towards expiry, your gamma and theta becomes more critical. So while you would always try to be delta hedged at all points of time, at the same time, you would probably want to be either vega hedged if your bet is not on vega per se, or gamma hedged. Now that's not all, and that's the sad part, or that's the difficult part. The fact is, you have risks like change in delta because of change in volatility curve. Volatility curve skew changing, volatility curve wings changing. So you use different levels of volatilities for pricing different options. Now that is your skew risk. Now if the skew changes, so if people start pricing the downside options much more aggressively, in that case you might be delta hedged, but then you might lose on skew. So if there is widespread panic in the market, people will start buying the downside puts a lot. So if the market is currently at 1050, they will start buying the 900 puts a lot. So in which case your risk is because of the change in the vol curve skew. So there is no one common, one direct answer, but then it would depend on the trading philosophy. Now, if your trading style is based on earning the time value spread, in that case, or if you are making a bet on volatility, or if you are making a bet on time value, in that case, you will not hedge your Vega or the theta, because you are trying to earn from that, you are making a bet on that. But then if your bet is something totally different, in that case, you would try to hedge your Vega and then your theta and your gamma and so on. Do we have time for gamma, or we are like very we have time for gamma, 5 minutes? How are people here? Are you guys okay with 5 more minutes? Okay. Okay. So basically gamma is the rate of change of delta. Now you might think that your portfolio was, has a particular delta, but then it will change with time, and then as you come closer and closer towards expiry. Now gamma scalping is a very popular form of trading for a lot of people with who can build huge positions. So what they do is they buy a lot of options, and then from those options they get a lot of gamma. So if you buy a call, if you buy a put, you get positive gamma, and then positive gamma means that you get the correct deltas when the underlying moves. What is gamma? Gamma is rate of change of delta with change in underlying. Now rate of change of delta with change in underlying. If your gamma is positive, rate of change of delta with change in underlying is positive. So you get positive deltas when the market goes up. If gamma is positive, you get negative deltas when the market goes down, because both the numerator and denominator have to be negative. So if both the numerators and denominators have to have the same sign, it means that positive gamma means you get positive deltas when market goes up, negative deltas when the market go down. Now how do you hedge your deltas? You hedge your deltas, positive deltas, by selling the underlying. If you have negative deltas, how do you hedge yourself? What does negative delta mean? Negative delta means that it's equivalent to being short an underlying. So you hedge your negative deltas by buying the underlying. Now if you are long gamma, you get positive deltas when the market goes up, negative deltas when the market go down. So if you are long gamma, you can sell the underlying, you can hedge your long deltas by selling the underlying when the market goes up. If you are long gamma, you get negative deltas when the market goes down. Therefore you can buy the underlying when the market goes down, because you can you get negative deltas when the market goes down. So if you are long gamma, in short, you can sell when the market goes up, you can buy when the market goes down. And isn't that the mantra of trading? You want to sell high, buy low. So if you are long gamma, you can sell high, buy low, the underlying. You can sell the underlying higher, you can buy the underlying lower. So if you are long gamma, that is what you can do. Now what is the downside to it? The downside to it is you get long gamma by buying options. Now if you get long gamma by buying options, you obviously pay theta premium for that. And the premium will keep decreasing every day. So the premium will keep decreasing every day. Otherwise everyone would love to have a long gamma position. You buy options, you become long gamma. When you are long gamma and the market goes up, you get to sell the underlying. When you are long gamma and the market goes down, you get to buy the underlying. Everyone would love to do that. Now, the downside is when you buy the options to become long gamma, you are actually paying premium. And the premium decreases every day. So you bought an option with a premium of 20. If nothing happens in the market, tomorrow the premium will become 19. Day after it will become 18. So the premium decreases every day. This is known as theta, the change in option price with change in time. So as you come closer and closer towards expiry, trading options is all about trading gamma versus trading theta. So how much money can you make by scalping on gamma versus how much money you are losing on theta? Or vice versa. You might think that I can sell options and earn a lot of theta and the market won't move, therefore I won't lose much on gamma. Okay. So the characteristics of gamma, etc. I will just skip. There are a lot more actually, and then basically there's just too much stuff which we tried to include in just one day's presentation. In fact, most of the stuff that we do here, just the option risks is 4.5 hours of classes. So basically, we are from Quant Institute. We have a 4-month course on algorithmic trading. It's offered online. So a 4-month course on algorithmic trading, 3 segments. The first segment is on basic to advanced statistics. The second segment is on quant strategies. The third segment is on the technology aspects of automated trading, working with simulators, working with big data analytical tools like R, working with an algorithmic trading platform, and so on. So just the risk management is 4.5 hours of classes. The strategies is, so it's a lot of things that we tried to compress into one segment. And then if you would like to know more, you can just get in touch with either of us or drop us an email or whatever, and then we would be happy to address your queries. Or you could join our course too. So any more questions? After a long and tiring day. Yeah, tell me. The ratio between gamma and? Well, gamma at the start of the month is not very relevant. So gamma becomes relevant only in the last 10 days of an expiry. So
I mean the ratio of gamma over delta.
Yeah, so
what does it tell us?
Okay, the first thing is gamma would be a very insignificant value at the start of the expiry. As you come closer and closer towards expiry, it will become a significant value. Now, the ratio of gamma versus delta, it could tell you, a higher ratio would tell you that this option could change from being in the money to out of the money. A lower value would mean that it's, so I would believe that it would just mean the moneyness actually. It would mean an ATM option will have a very huge gamma, and then out of the money and in the money options will have very less gamma. So where is the graph of gamma? So as you can see here, this is gamma, the chart of gamma versus time. So the gamma explodes for ATM options. So gamma versus delta, because gamma itself is quite huge, therefore gamma versus delta will be a very huge number for at the money options. For out of the money and in the money options, it will be very less. So if you ask me, it doesn't tell me anything. There are quite a lot of numbers that you see in option trading. So you see not just gamma, delta, theta, vega, but then you see all these. Where are these numbers? You see this whole host of numbers. So people try to mix match different numbers. They would try to divide one by another or multiply one by another. But then if you ask me logically, gamma by delta wouldn't, people could design strategies out of it, but then I wouldn't believe so. Yeah, any more questions? A more relevant question would have been the ratio of gamma to theta, I guess. How much gamma versus how much theta you are paying for that. That you could analyze that to decide whether you want to be gamma long or gamma short. Any more questions? Okay, I guess we can call it a day here. So thanks a lot, everyone, for your time. Thanks a lot to both SET and TFAX for the wonderful reception and for organizing it so well. Thanks a lot to Flextrade for being an organizer and then sponsor of the event as well. And it was actually very nice interacting with all of you, not just now, but then during the break and then getting to hear insights from you about the markets and your thoughts about the options markets in Thailand and so on. And then we stay very hopeful and enthusiastic about the options market in Thailand.
All right. Thank you very much, Mr. Rajib and Mr. Nitesh, for your presentation. We actually, finally, on behalf